Hey everyone, Steve here from 11ish, a channel where we talk about lucrative investment strategies and opportunities based on the requests from the 11ish collective. In this video, we're going to talk about the untimely event of Archegos fund management and how we, you and I, retail investors, can capitalize off of this event. If this is the type of content you've been looking for, please hit the like button for me, and let's get started. So the quick backstory is that Archegos Capital Management Fund is managed by a group of folks led by a smart guy named Bill Huang. He basically turned $200 million into $10 billion in less than 10 years. Really, the only realistic way of doing this is trading stocks leveraged. That means that when you trade $10, you leverage it so that it becomes more like $1,000, right? I'm being a little bit more dramatic here just to kind of prove a point. The outcome is the same. You basically leverage your money so much so that you're essentially investing with a lot more with borrowed money. So if you're not playing with options or not leveraging your money while you're trading stocks, then let's say the stock market down due to a blip event, right? When that happens, you can sit on the stock. If you've made a good investment, the company is not going to bankrupt, and therefore you can just sit on it until the stock regains and probably some more. That's essentially my fundamental strategy, right? But if you leverage your investments, then both the positives and the negatives get amplified. And the biggest challenge that most people don't realize is that when the negative events get amplified, the people who let you borrow that money in the first place, they're going to chase you down and make you pay it back. You cannot just hold it and wait for the stock to come back. I mean, you can do it to a certain extent, but it really depends. In this case, a bunch of companies had negative events, and companies like Goldman Sachs and Morgan Stanley forced Bill to liquidate. The purpose of liquidating is to minimize risk. They're going to get their money back at a loss, most likely, but it's to minimize any further loss. So the outcome of that is Bill has lost his $10 billion stake, his entire stake, and companies like Morgan Stanley and Goldman Sachs alone wrote off $20 billion, right? Because they're the ones that lend him the money to trade leveraged. So if Bill loses 10 billion, all the companies that lended him money will lose a lot more. What does that mean for us? That means that a lot of companies got liquidated really, really fast. And since the stock market is built on supply and demand, all of these companies that Archegos invested in, they tanked in a very short amount of period. Because Archegos does not publicly announce what they invest in, you do not know what that list looked like. But a handful of stocks, they basically tanked out of nowhere. And so I think that's a strong indicator for the fact that they're part of the Archegos portfolio. And in this video, we're going to talk about one of my favorites, two of them actually. In the past, you've seen me talk about Tencent, one of my favorite Chinese companies. They're basically a conglomerate that does a bunch of things and does it very, very well. They also invest a ton of their money into industries that they care about, right? One of them being online gaming. If you are interested in that video, please check it out. I'll provide the link below. But in this video, I'm going to talk about one of their subsidiaries, Tencent Music Entertainment Group, TME. It has its own stock ticker. That stock has tanked really, really hard, noticeably hard out of nowhere. And that stock, but the company is doing very, very well. So the tanking is in fact a buying opportunity. The Tencent Music Group essentially is, you can think of it as the Spotify of China. First and foremost, I love investing in the music industry because generally speaking, it bridges gender, race, socioeconomics. It is an industry that has huge total addressable market. This is why every once in a while you see YouTubers who outperform, right, gather a shit ton of audience and lands a major contract. Because ultimately the people speaks for who they want to listen to. That, in my opinion, is the beauty of the music industry. Therefore, between music and podcasts, I think that online digital music streaming is a huge, huge business. I like TME better because I think that there's more growth opportunity for the company. But going back to my original point, right? TME is essentially backed by a shit ton of money, Tencent, right? It is partnered with Spotify in that they actually swapped 10% of their shares. So Spotify owns 10% of TME and TME owns 10% of Spotify. And then thirdly, TME has just landed some major partnerships with Warner Music, Sony Music, what the hell's the other one? And Universal Music Group. These are great indicators that this company will stay. Even if the stock doesn't recover quickly, this company is the one to pick. This is the right racehorse. Before the stock tanked, the PS ratio was 16, and now it's 10. The PE ratio is around 60 last I checked. And so this stock is definitely still on the frothier territory compared to Spotify, but I think the growth opportunity is a lot bigger. Plus, in my opinion, the worst case scenario is that you hold it for long term, right? Because again, Tencent is a company that is known to make a shit ton of money. They're definitely not going anywhere. They have a great track record for every industry that they get themselves into. And so I'm willing to bet that this company will do well in the long term as well. So the things to watch out for. As I said, the stock is still in a frothy territory, but this is a frothy market. So if you're willing and able to play in this market, you have to take that into account and accept the consequences of such. And like I said in the past, ideally you choose stocks where they have long-term growth opportunities anyway, so that you protect yourself. In my opinion, best case scenario, the stock regains its loss, and then I'll probably sell at least half and then reevaluate my situation. But worst case scenario, I'll hold it on for the long term. I think this is a great bet either way. Second risk is that I definitely think that US policies directly influence the performance of Chinese stocks, so be wary of that. The fact that US policies potentially affect Chinese stocks negatively, whether they deserve it or not. Some of them do deserve it. Honestly, I do believe that. But this one, I don't think it should affect it, and I don't think it would deserve it if that happens. But I can't predict the future, and I can't control that kind of sentiments, right? So that being said, if a Chinese stock and its businesses concern you, or you just don't like to mess with something that you already know, then I recommend that you invest in Spotify instead. I think that has a lot of growth potential as well. I think it's a great, reliable company that's doing great things in the type of contracts it signs, for example, Joe Rogan, and also in the podcast space that is playing in general. That's a huge, huge growing market that we should all be aware of as investors. All right, guys, so this is what I wanted to talk to you about today. I hope it made sense. Let me know your thoughts. If you have any questions or concerns or suggestions, please leave me a note as well. And if you're actually really enjoying my content, please check out my website, linked below. I actually publish my written content before I publish my video content, just because that's the script that I base my videos off of, and it's easier to publish, right? So that's it. Thanks for watching, and I look forward to working with you next time.